Welcome everyone. So thank you for joining. We will present a webinar about digital asset management and the current landscape of the investment funds about digital assets. It's to give you a glimpse of the fund industry in that sector with different actors around the table sharing their views. So the webinar will be divided into three themes. The regulatory structure first, then investment strategies and limitation around the funds investing into crypto assets, and the depositary and the custody solutions. So I am Robin Ledoux. I am head of fund administration and valuation at 6monks or 6M. And we are an alternative investment fund manager specialized for PE, VC funds. And we are the first and so far the only IFM to be authorized by CSSF to handle funds with crypto assets exposure within a regulated environment. I will give the floor to my colleague to introduce herself.
Sure, thank you very much, Robert. My name is Filip Suchta. I'm a director at Q Securities, an alternative investment fund depository that caters to all types of investment strategies, including, especially in recent years, to crypto funds.
All right, so Thomas Campione, PwC, in charge of our digital asset activities, and very pleased to be with you guys today.
And I'm Chris Hollifield. I head up business development at Luxembourg for Finance, which is a development agency for the financial sector of Luxembourg. Great to be here today and to talk about such an interesting topic.
And to kick things off, maybe could you share with us an overview of the current landscape for digital assets investment funds, including key trends and regulatory developments?
Do you want to go first, perhaps?
Yeah, I can start. I mean, I have a couple of points, obviously. I think that the crypto industry has definitely matured over the years, but if you make a snapshot today, we have a significantly different market structure than over the last 2-3 years. And it has changed because of the massive entry of institutional players. But on both sides, actually, on the side of the service providers and on the side of investors as well. And the latter is actually having an interesting yet a bit challenging side effect, in the sense that, and this is even truer over the last couple of weeks, is that with the massive entry of institutional players as investor, those investors are actually trading crypto the way they would be trading a classic stock. And which is not exactly what you would have expected from crypto, because that was supposed not to be that correlated with tech stock or small cap stock. And what we see at the moment is that those big players are trading crypto the way they would be trading small cap tech stock, which is increasing the positive effect when the market is positive, but also the negative effect when the market is negative, which is a bit counterintuitive compared to the initial value proposition of crypto. Then we have also a much different dynamic than what we experienced over the last couple of years. A key element here is that over the last 12-18 months, the market has demonstrated the commercial viability of crypto-based product, which is different than what we experienced before. Now the market knows that there is demand, there is commercial success of crypto-based product, and that's a different reality. And as a consequence of those two elements, last one is the first element is that average comfort of market participants significantly increased, creating a positive feedback loop in terms of the market development. And then last but not least, there is this convergence that we see between pure crypto asset and tokenized assets, which is something that we will not really discuss today, but both are important. And we see initially there was kind of an opposition between the two, specifically for traditional players. Now we have a convergence. So this is a bit in a nutshell what I see in terms of big points there.
Yeah, I mean, I think those points really resonate with me as well in terms of particularly institutional take-up, and then also obviously, that kind of specialization of the sector as it goes forwards, and that correlation between traditional financial services and that moving over also towards crypto assets. I think the other point that's important to make is that the regulators have also woken up to the sector, particularly if you're looking sort of from 2018 onwards. Here in Europe, we have now MiCA in place fully in place as of January this year. But if you're looking globally as well, you've seen an uptick of regulatory frameworks around the world with 64 jurisdictions now having comprehensive regulatory frameworks for crypto assets, and then 41 also having stablecoin ones, particularly post the Libra DM project. What's I think the interesting thing on the regulatory front at the moment is really how particularly the policy changes in the States, the replacement of FCC Chair Gary Gensler with Paul Atkins as he comes in, what sort of effects that's going to have on adoption over stateside, and I think we're starting to see some momentum there as well. And the key thing that I'm looking at personally is obviously an EU with an EU focus is then the fragmentation and potentially of regulatory frameworks between what's happening here in Europe, what's happening elsewhere in the world, and then what happens in the States. Crypto is obviously a borderless asset class. But that doesn't mean that the regulatory frameworks shouldn't exist. It means that there's a need for strong regulatory dialogue across borders. Just to finish as well. I think that Thomas is absolutely right when he points out increasing complexity and specialization and institutional interest both on the investor side and on the service provider side. The big news last year was obviously the BlackRock ETF, which was one of the fastest growing, BlackRock Bitcoin ETF, which was one of the fastest growing ETFs that they had ever. We obviously have a slightly different approach to funds. Crypto funds here in Europe, which is one of the topics of discussion today. But certainly, I think that there's a strong entry of traditional investors into this as an asset class that forms part of their portfolio or forms part of their service offering. And with that, I think I'll hand over precisely to maybe follow on that discussion of what are the benefits of this kind of indirect investment approach rather than just going on an exchange and trading yourself. What can you guys do to help, basically? So I'll hand over to you guys to maybe talk about that.
Yeah, actually, indirect investments in digital asset through funds offer several key advantages. So the first way is it's a familiar way to invest for many investors, because we will see later on, but the legal structure and the investment structure are quite similar with other asset class. So meaning private equity, VC. So we will see later on in details, but it's one advantage for the investor. And the second one is the protection of assets, because also we will cover later the ecosystem around the fund, but there is a segregation of duties between actors and the regulation over the different actors. So it's really important for the investor to have this protection of assets, and a key differentiator with a direct detention of token for the investors. And the third one is the daily life of the investment, because all operational aspects are handled by dedicated entities. So from an investor point of view, it's easy to gain exposure to a new asset class and to have to find new ways to diversify his investments and to find new profits from an emerging asset class. And from a fund initiator point of view, it's also easy to run his investment strategy. So he can focus only on the fundraising, the distribution, and the investment strategy. And all other aspects are handled by the different actors around the table.
Yeah, I mean, I think when you're talking about indirect investments in crypto assets, you can point to many benefits. The diversification, the experience and professionalism of service providers, You have, the increased security, exactly what you mentioned, with all the regulated players involved and really institutional grade facilities and services, and the regulatory oversight. But to be honest, that's, if you're thinking about it, that's just one benefit. It just makes for a safer, or at least less risky, way of investing and gaining exposure to this particular asset class, which I think, it's a benefit for every type of indirect investments in any asset class. All of these factors that I mentioned. So for this particular asset class, with its volatility, still relatively, the factor that it is still relatively new to a lot of investors, which might not have personal experience in investing in them, I think it's just the best way to go. In other words, if you're investing yourself, you're on your own. If you're investing in a fund, you have this multiple players that, even though, Robin has a different role as an AFM, I have a different role as a depository, but we share a common goal of protecting the client's interests. And I think, that's the major benefit, of indirect investments in crypto assets. So we discussed the benefits of investing in digital assets through funds, and we might be a bit biased, obviously, to say that this is the best way to go. But I really think so, particularly for investors which don't have the necessary expertise or the time to actually properly manage their investments on their own. Now, I would like to turn the discussion to what options are there on the table. We're talking about investments in crypto assets through funds, and what types of investment vehicles are there? Could you maybe, perhaps as a fund manager, describe what options are on the table and discuss the pros and cons of each solution?
For sure. Actually, we can see two different types of funds for investments into crypto assets. We can see the de minimis funds, so basically some SCSPs who brings more flexibility to the investors. But actually, there are some also cons about it, because they are limited in terms of fund size, and depending if they are using leverage or not. And actually, it's quite hard to have open-ended funds, so it must be closed-ended funds. So for the investor, for the liquidity, is also quite difficult to manage. And for de minimis fund, you cannot market, communicate, or distribute the fund across Europe. And it is less regulated. So basically, it is less secure for the investors, and consequently, it's less attractive for institutional investors or professional investors. And on the other hand, you have RAIF regimes, so reserve alternative investment funds, and which is a common envelope for private equity and VC. And there is no size limit, so that's the first advantage. It's possible to market, to market it, to distribute the fund across Europe, benefiting from the EU passport. And it's easier to attract institutional investors. So institutional investors, professional investors. But you need more actors around the table, for sure, because they need to be regulated. There is a segregation of duties. And all actors must be independent and regulated. So that's... and at the moment, we do not see any other type of funds investing or with an exposure to crypto investment so far.
Yeah, that's exactly what's going on. We have two main approach at the moment, and two only approach. Let's see what's gonna come up out of this consultation from ESMA. Are we gonna end up with crypto in UCITS? But for the moment, these are the two main approach. Maybe, guys, as a follow-up question to those two verticals, somehow, what should our audience know in terms of what are, I'd say, the concrete operational and practical implication of those two scenarios for asset servicers and asset providers? I think that might be important.
Yeah, I can go ahead. Sure. I mean, for depositories, obviously in that unregulated scenario, we are not involved, sadly. But maybe possibly better for the fund promoters, because it has to be a light structure in order to be unregulated. So I would say that, sort of following up on what Robin said, the unregulated entity and the unregulated structure has its benefits, but I think for this particular asset class, the increased regulation, the increased layers of protection are crucial. and the increased transparency that you get from being able to market it throughout Europe fully, openly, telling the investors about it, not relying on, reverse solicitation or private placement. That's definitely the right solution to go with a regulated or a semi-regulated structure like the RIFE. I mean, for a depository, the implication is really boils down to two issues. First of all, do I want to be involved in that particular asset class? And we've been seeing various approaches from the Luxembourg depository sector. I mean, obviously, you need to do a proper analysis of all the benefits, of all the risks. You need to be sure you're prepared. I mean, for now, we're seeing that a number of depositories, I would say the vast majority of depositories present on the Luxembourg market, have no appetite or very little appetite for crypto funds. And to be honest, if they don't feel comfortable with this asset class, they're not sure what they have to do to properly fulfill their duties, I think that's the right decision at this stage. I hope that this decision will change, even though as one of the very few depositories that offer these type of services, we are keen to see competition because that will help the market grow. I mean, so the first topic is basically deciding if I want to be involved in that asset class. And the second decision that you have to make is exactly what types of services do I want to offer? Because I will repeat that many times during this panel, but there are two basic models of how you can work as a depository. You can either just provide the depository function, which is, a challenge in itself, but you can also combine it with the crypto custody function as regulated by MiCA. And of course, that's a very different story, because then you are entering a new space regulated by MiCA. You need to adapt to all those regulations. You need to invest in HR, in IT infrastructure to make sure you're properly fulfilling your duties. So I would say these are the two. If you want to be involved, and in what capacity.
Yeah, maybe I will start with an overview of the whole ecosystem around the fund, and especially for digital asset fund, because it's similar to what we can see for a pure PE fund, for example. So basically, the fund will have an IFM to handle the legal compliance aspects, the monitoring of risk management, the portfolio management, the valuation. The fund will also appoint a fund administrator for fund accounting, transfer agents, investor reporting, and depositary bank, a custodian, an auditor, and really all for sectors, for stakeholders, which are similar to any other fund. However, all for sectors must have the necessary expertise to handle crypto assets. And for some of them, a specific license from the regulator, like the one we have for AFM. But more importantly, they have to have process in place to handle the specificity and all the different mechanisms linked to digital assets. And we can see more and more institutional and regulated actors entering into the markets, providing new services. And it just follows growing interest from regulated crypto funds or institutional demand.
Okay, thank you.
Maybe, on the impact of MiCA. So with the introduction of MiCA, the regulation for marketing crypto assets, how do you see the impact of this regulation and the competitive position for Luxembourg?
Well, as I say, I mean, just as a broad comment to start off with, I mean, the main and most important point about MiCA is that it provides a level playing field, a category of regulated and supervised entity that allows somebody who's providing services for crypto assets to talk with other regulated entities and financial services on an equal footing, which wasn't the case before, with VASP registration, which is a national registration regime just purely for AML purposes. And so I think the sort of knock-on consequence of that, and it's quite interesting to have just listened to this discussion around SESs and limited partnership regimes and RIFEs in Luxembourg, is it creates a strong connection between service providers for crypto assets and the broader sort of Luxembourg ecosystem, which is highly specialized in terms of dealing with client money through wealth management tools, through the asset management sector, and through the sort of broad toolbox that we have here in Luxembourg for fund services generally. And so I think that, creating this kind of connection, I think Miko is very, is a real catalyst in that sense for creating that strong connection between the traditional strengths of the Luxembourg financial sector and this new asset class. I think also I would point to the fact that the CSSF has been relatively proactive as a regulator and knows its stuff when it comes to crypto. It's been relatively proactive with the sector also in terms of providing guidance both to AIFM or to fund managers, to the fund sector, and also to the credit institutions here in Luxembourg publicly on its website. But I think so I think it's a good start. I think what's more is needed has been really highlighted already by our speakers. It's really ecosystem depth, where there's a very strong depth in the traditional asset classes and the traditional service providers for those. And we're looking forward to Mika really being a catalyst for that also to happen in the crypto space. And then the last point, and then I'll stop and let Thomas speak a bit. The last point is that as I say, crypto assets are increasingly, in my opinion, an asset class that is part of a broader portfolio of asset classes. But I think also they present a very interesting user experience, which is quite different from what we expect of other asset classes. And I think some of the changes of user experience in particular that we're seeing for crypto will also translate or are also translating into other asset classes. And there I would point to the work that's being done around tokenized securities and digital security tokens here in Luxembourg through the blockchain laws as being something that's happening in parallel to drive the overall competitiveness of the Luxembourg financial sector, both in securities and also in crypto. And then I'll stop there.
No, I mean, what can I add? I mean, it's a very complete question, answer, sorry, and I fully agree. And I would just maybe add two points or summarize that. Is on the one side, clearly, it is fair to say that MiCA is not perfect. Some provisions are, they are what they are. It's not perfect, but at the very least, MiCA is creating the condition for a much broader crypto asset industry, increase or improve investor protection. So overall, it's net positive. The regulation will evolve over time, but it should create a positive feedback loop across the industry. That's the key points. But the flip side of that is that MiCA is an harmonized framework. So meaning that member state, it will be much more difficult for member state to stand out of the crowd because that's an harmonized framework. So the regulatory posture will be hopefully mostly the same across Europe. So it also means from a competitive standpoint for Lux is that the regulatory posture will not be a differentiating factor anymore. So the differentiating factor will be the size, the breadth, and the quality of the ecosystem, the expertise that we can build locally, and also the product and services that we can create out of Luxembourg, leveraging our, let's say, traditional cross-border approach. But it takes more than a piece of regulation. This is about the market participant to make it happen. So MiCA has very positive, effects globally, but for Luxembourg, that's also creating some new threats if we do not muscle up, because other will do.
To connect to this comment about the investment services and products, we spoke about investment vehicles, we spoke about the implications for service providers, including those arising from MiCA. What I would like to now shift our focus to is investment strategies. So, Robin, you're the only AFM in Luxembourg that can manage virtual asset funds. What types of restrictions are there? Can you, do you have to invest everything you have in your portfolio in crypto, or can you diversify a bit with regards to different traditional asset classes? And is it really, when's the line? When you stop being a crypto fund and when you start being a crypto fund? So if you could give us a bit of perspective on that.
Yeah, for sure. Thank you. Actually, what we see is really from the fund promoter, the project of the fund promoter. Basically, we are because we are a third-party management company. So basically, it's really depending of the project, the initial project of the promoter, of the initiator of the fund. And what we can offer is a pure crypto exposure, so direct or indirect, but a pure crypto strategy. PE strategy around blockchain and Web3 environment with investing into companies active in that space, or a mix between the two, because sometimes you enter into deals and you get at the end you get equity and sometimes tokens in the Web3 environment. But even if the investment strategies are quite flexible, for sure, AML, KYC diligence must be performed on each assets the same way than PE or any other funds. And us as fund manager, we must be comfortable with the valuation of the underlying. And also, my colleague from portfolio management team must have all the necessary skills to run the strategy initiated by the fund promoter. And for some structure as well, so namely the RIFE, there are 30% risk trading rules which apply. So basically, for an active strategy, it's quite easy to comply with, but you have to keep in mind there is this rule.
Absolutely. And Thomas?
Yeah, just maybe to add on that, to also use this forum as a reminder, and because I'm not, to be honest, I don't feel like it's known enough across EU and even globally. But in line with what you were saying, we were talking before about competitiveness and positioning of Luxembourg. I think the audience needs to know that it's, if not unique, pretty unique what is being allowed here in Luxembourg, i.e. having indirectly regulated investment product providing up to 100% exposure, direct or indirect, with the setup we know, and we'll come back on that between the depot and the custo. I don't think you will find that anywhere else in Europe at the moment. You will be opportunity to have an exposure to 20%, 5% in certain countries. But then the trade-off between all the effort you need to make and the benefit that you can get from the exposure is more limited. So we have this flexibility for a complete business model around crypto in Luxembourg, which is pretty unique to the best of my knowledge. So important to remind that to the audience as well.
Robin, maybe you could just touch a little bit more on how the fund promoter can actually get involved in the investment management process.
Yes. Depending of the initial setup, anyway, the fund promoter keeps a key role in the investment management process. So either he can run the investment strategy by himself, but it means he has the relevant firm to do so and act as portfolio manager itself. But what we usually see is a setup where the fund promoter acts as investment advisor. So meaning we do the portfolio management internally and we receive signals, advice from the investment advisor on the strategy to apply on the potential trades and so on. But we execute at the end the strategy and the trades. So the fund promoter is really key in the process, and he also can be part of the general partners and keep at his level the final decision of the investments, considering all the regulatory diligences as AML, KYC, or every operational aspects have been completed before.
Okay, interesting. So I think that at this stage we discussed the global perspective, the regulatory developments, the strategies. It's probably no time to enter. I mean, what is perceived as, if not the hottest, one of the hottest topic in the crypto space, custody, and the interaction with the depository function. We kept hearing about this misconception, the famous sentence, not your keys, not your crypto. We were discussing before about, the convenience that was brought or provided to investors to have this indirect exposure so that they get rid of the custody risk at least. But I suspect that the custody risk exists, still remain. So what's your view, Filip, on that? And how do you handle that from a regulated status standpoint?
I mean, that's a very important topic, particularly for funds, because I agree there's been a lot of misconceptions, and they mostly arise from the fact that we have overlapping regulations. We have the AFMD that regulates the depository role and its liability, especially the liability for loss of financial instruments. And on the other hand, we have MiCA, which in Article 75, has regulation concerning crypto custodians, and also introduces, a restitution liability for loss of crypto assets. A bit different, but definitely inspired by AFMD. So you will have a lot of misconceptions around this, and I would say it largely depends on the operational model that a depository uses. Because from an AFMD perspective, most crypto assets would be classified as other assets, meaning they are not held in custody within the AFMD sense. So for that particular scenario, if I'm just a depository, I fulfill my safekeeping duties by verifying ownership, which is quite easy to do with digital custody wallets, and I keep records of the assets that they have. And I'm only liable if I'm negligible and there's a failure, if I haven't fulfilled my duties properly. Now, if I'm also a crypto custodian, then that's a different story, because then again, MiCA applies, and I will be liable for any incident that is attributable to me, which is, I agree that, MiCA is a harmonized regulation, but I think there will be some discussions of what exactly is an incident attributable to the custodian. And then my liability is limited to the market value of the crypto asset lost. And of course, we've seen, especially in recent times, several scenarios where that liability might trigger. So I would say in that scenario, it's a different story for a depository, because it does have this loss of liability regime. In our setup, where these roles are split, then we are responsible for the ownership, verification, and record keeping, and the crypto custodian is responsible for keeping custody of the documents, and they are the ones facing this liability. And of course, under MiCA, they will have very similar duties to the ones that a regular custodian would have, with segregation of assets, and identifying the assets of the client. And again, this is the different animal a bit, the crypto assets. So a lot of classic custodians are not that familiar exactly with, are they keeping the assets, or they're just keeping means to the asset, which of course, again, allows lawyers to spend a lot of time discussing of what exactly are the limits of this liability. I will add that there's also there can be crypto assets, or maybe digital assets would be the better way to put it, that can be classified as financial instruments. And then there's again a question, and it's not exactly clear at this point, and I think it will be mostly clarified because it is the domain of AFMD, which is a directive, not a regulation, of whether or not you can keep digital assets that are financial instruments in custody. Because physically you can store with a cold wallet. There are scenarios that we can physically store means to a digital asset, but doesn't mean it is a financial instrument that is held in custody by you, and you're then liable for the loss of it. This will be up to some discussion, I think, between the regulators and ESMA.
Yeah, but I think this is really important clarification, and again for the audience, because I'm always surprised it's still recently, there's a gap in terms of the understanding across market participants. On the one side, you may have discussion with depository bank who are telling you, look, it's too risky for me, I don't want to own all those risks, the restitution element, whereas they wouldn't be actually facing that risk. And on the other side, you have crypto custodian, either VASP or CASP, who are begging to take on those risks because this is their business. They're more than happy to take it. And there is this gap that creates immobilism, but actually the setup can be accommodated by both parties. Exactly.
Absolutely. Yeah. With the proper setup, I think, the depository's risks are properly managed, and you have a crypto custodian that is dedicated to fulfilling this type of role.
And from this basis, is it possible for a fund to use a self-custody solution, specifically if there are some tokens which are not handled in a custody solution?
Sure. There you have a couple of factors that are in play. So it's the shortest answer is it depends. The longest answers, which I guess our audience is more looking forward to, is the fact that it is not regulated by MiCA that you need to have a crypto custodian. It's an option for market players, for clients to use. So again, we're coming back to guidance from local regulators, because neither AFMD nor the upcoming AFMD2 really covers or touches on that topic. So in Luxembourg, we have the advantage of, again, as Chris said, CSSF being quite proactive and in issuing guidance saying that, you need to have a crypto custodian appointed. That is a VASP at the moment that will probably soon to be with the next update, a CSP one that once there are some that obtain licenses from the CSSF. So and again, I will come back to the differences between two models. So obviously, if you have a depository that's at the same time a crypto custodian, then you have to use them, and you're limited to their offering. So you cannot use a different crypto custodian unless, of course, you come to such an agreement with your depository. With our model, where we're responsible for the depository role, and there are crypto custodians, because they're, again, like with AFMD, you have a single depository rule. A fund needs to have one depository, not more depositories. With crypto custodians, the field is a bit different because you can use multiple crypto custodians. So you can have one main crypto custodian, and for example, if there's an asset you want to acquire and your crypto custodian doesn't cover it, you can go to someone else that is able to sort of to make sure that all of your bases are covered. So and that's obviously for semi-regulated and regulated funds. So we spoke about RIFs, we spoke about SIFs. These are the sort of the funds that have this guidance from the CSSF. They need to have a crypto custodian appointed. Now, for the unregulated funds that we also spoke about, I think it's a bit of a different story, because obviously AFMD applies to them in a very limited manner. So they don't need to have a depository at all. So again, I think what I'm reading from the guidance from the CSSF, and that obviously might change, is that they can do self-custody. Now, obviously, that increases the risks related to investments. We spoke about the limited transparency, the limited distribution capabilities of such structures. And if you add on to that the risk related to self-custody, then of course that increases the overall level of risk even higher. It is possible that with the I would assume upcoming update of the FAQ issued by the CSSF, we will reach more clarity about this in this post MiCA world.
Maybe worth noting as well that just to put things into perspective, we're talking about new investment product targeting well-informed investors. And usually those type of profile will not look for the most exotic assets out there on the one side. On the other side, we have regulated custody who are handling more and more in terms of scope of crypto assets and things. And this scope is not written in the stone. There's always a way to engage with those entities, custodian, just to open up and to broaden the scope. They might need to have a business case, but they can accommodate and onboard new assets the same way that we onboard new investors, subject to proper due diligence. So it's not there is no go by design.
Yeah, absolutely.
We have flexibility there, and those who are looking for investing, launching new products with top 20, top 50, even top 100 will not face any issue with finding a proper regulated custody. So that by the time they need to go for potentially self-custody, the market will be much more advanced than what we are today, at least for well-informed.
I fully agree.
So we have some time.
Yeah. So with the time in mind, I think it's a good time
What a transition,
to transition to summarizing today's webinar. If you could briefly, a couple of sentences, just let us know, and the audience know, what are your thoughts on today's topic and the outlook in the future.
For sure. In my opinion, for the outlook for the future, I guess digital assets will become a classic asset class, like private equity or VC, and it's just a way to diversify his portfolio, his allocation of investments, and to find new profit sources. And Luxembourg is becoming the key player in that field. So there are more and more actors, regulated actors, starting their operation in Luxembourg, and I think this is really key and on a good trend for the future.
Yeah, I mean, fully agree. And just to summarize my view, I know that the audience and the rest of the market have heard that this time is different already a certain amount of time. But I've been in the space for sufficiently long now to see that there is this combination of elements which having an augmenting effect on each other: regulatory, entry of institutional, new product, commercial success, which makes me feel that we are really having an acceleration, an inflection point, and that the next couple of months will not be linear. There will be an exponential growth. That's one thing. Second is that Lux has all it takes to lead the space. We have the ecosystem, we have the rec, we have I hope, the willingness from market participants. But the reality is as well that we need to muscle up because others wants to have a piece of it as well, and they are catching up quickly. So huge opportunities, but we need to seize them.
Yeah, I mean, I fully agree with these statements. I think that MiCA is a first step, and I think also the other thing to say is that crypto space, CLT space, generally Web3 moves at light speed. It's super fast, and I think that as such, you really have to see it as just a first step in a very long and continuing sort of dialogue between traditional actors, regulators, and this particular sector. I think also increasingly what's happening in Web3 is being mirrored in other asset classes. And I think I could fully subscribe to the idea that crypto is increasingly just becoming another asset class in a broader portfolio of things that will start to resemble, I think, also the way in which crypto is traded, custodied, at the service provider industry around it. I think Lux has the right tools. I think it's also open to new players. So if you are interested in, if you are in the space and you're interested in discussions, and please do reach out and contact us. And I'll stop there.
Yeah. I mean, I thought about circling back to what you said at the beginning, Chris, with the situation in the US.
Yeah.
And, I've been at a number of events, and wherever I go, I hear, that the US innovates and EU regulates. But I don't think that we should copy the US approach. I think there is strength in regulation because, this asset class is particularly, the investor protection factor is very important. And I think that regulation gives a framework for providing the investors with adequate protection to help them come to this asset class and become active in it. And I fully agree that it will become, thanks to that, a classic asset class. And I think what we really need right now is we have this backbone of strong regulation. And now what's important to be done by all stakeholders, by the regulators, lawmakers, of course, market participants, is to make sure that there's enough of us. That's exactly the depth of the ecosystem. There's a number of players that are licensed, that can service multiple asset strategies, and that can make sure that Luxembourg becomes a primary jurisdiction also for these types of funds.
Fully agree.
Yeah, I'm happy that we were agreeing. So with that in mind, I think we can thank the audience of today's event. So we hope it was informative for you. Thank you so much, and enjoy the rest of your day.
Thank you.
Thank you.